Hey everybody, it's Michael Martin. Thanks for being here for today's video. I try to create them at least one a day for you. Please like and subscribe. I get really good data that you like so that this way I can create more videos that resonate with you as opposed to ones that are just meh because it happens every once in a while. Also, check out the links below. We have links for our courses as well as a free download for the audiobook version of the Inner Voice Trading, which I've been giving away for free. Check out the link below. Help yourself. It's on me. It's about a 400 or 500 megabyte file, so it might take some time. But again, it's on me. Thanks for being here, folks. Check out the video. Hey, everybody. It's Michael Martin. Thanks for being here. I'm going to do something that I almost never do, which is like an explainer video, a little trading tactic video here. I'm very grateful for everybody who listens to the show on, like, say, Spotify or any of the podcasting platforms, and now on YouTube. And I get a lot of email because folks seem to trust me, which is a great feeling. So thank you for that. But I did notice that when people write in and they ask me to review some of their trades, I listen closely to the language that they're using so that I can better understand, what it is that they're actually trying to achieve, because people will tell you if you just let them talk. And so I listen to, what they say. I certainly read the emails, every word myself. And I've kind of come to the conclusion that and this happened like over the last probably 40 or 50 emails, where people wrote in about, hey, would you please review a trade for me? And they wrote it out. Maybe they diagrammed the chart, sent it over. I came to the conclusion that a lot of them don't understand the difference between a stop order and, say, like a limit order. And from the days when I used to teach in the classroom, much more frequently, my ethos was that if one person's asking a question, there's probably 10 more people who want to ask the same question, but they don't know how to ask it, or they don't want to look stupid, or maybe they're going to approach me after the lecture, this, that, or the other thing. It's all good. And I'm certainly not making fun of anyone, but it occurred to me that everyone's out there looking at chart patterns, trying to find the magic setup. And the reality is like, that to me is like trying to find the next Maybach or Mercedes AMG, but you really don't even know how to drive all that well. So the key to trading is knowing tactics, right? Knowing how to anticipate what human behavior is going to unfold, and then placing your orders accordingly so that when the market does move, you already have an order in the market ready to go to capture the momentum, right? Because after diversification, momentum is probably the next most important thing. So I put a couple of charts up. The names and the tickers don't really matter because these aren't trade recommendations. It's just more tactical use. So the first one would be to use a buy stop when you want to enter the market long with no existing position. So you're following this particular name and you notice that it's selling off. It's clearly in a downtrend. And what is it that you're going to do? You think it's going to bounce. So how many times people try to buy pullbacks, right? Now, again, this is not a recommendation to buy this security at all. It's probably below vicious downtrend here where the stock literally got cut by 75%, $30 out of the 40 that you saw on September 12th. And so what happens is, as the thing pulls back, people think they can get the thing on sale. So what do? They enter market orders on any of these places along here. And, that seems emotionally appealing because you save what you perceive yourself saving money. When the thing goes to 20 after it's been to 40, you're like, man, the thing is on sale. I can buy everything that I want here. I can get twice as much. But what smart people do is they say, well, I want to wait for the trend to turn and see some positive slope here. But one thing that you can do if you're a dip buyer is wait for the pullback, wait for the consolidation. And then, for example, like enter a stop order, say right here. Why? Well, you see the sell-off, it's got some consolidation. Don't try to buy it in the range. It's small potatoes. You don't care about $1 on a $20 stock, right? You're looking to make $10, $15, $20 on a $20 stock. Think big. So what you would do in this case is enter a buy stop order above the current market and wait for the market to trade at or through the stop price. And you'll get in line with all the other purchasers and you'll add the risk to your portfolio. Now, There's something that's psychological to this too, which I'm going to come at in a minute. You noticed here, you never got filled. It broke down. It traded sideways again. You could say, okay, I still think it's going to bounce, but maybe my trading range was different. So now I'm going to enter my buy stop order at say 16. I'm going to drop it $5 from say 21 to 16. Again, you don't get filled. Market sells off. Little short cover rally up to the trend line, and then you see more horizontal movement here. So you're like, okay, well, so far my thesis has been wrong. It hasn't bounced. But the good news is that, and this is the emotional and the psychological part, is that you didn't act like out of emotion and add the risk to your portfolio because you felt like, well, the thing was from 40 and now it's at 20. I can get it at this 50% sale. I can add this to my portfolio. I can buy twice as many shares. But now what happens? Now you're below 10, you're off 75%, and your stock that you bought at 20 is down 50%. So now you need to see the thing basically double for you to get to break even. So you can avoid all of that emotional duress by using stop orders and let the market come to you. So now you could put a stop in at 10, in which case it fails, it doesn't get filled, and you see another line of consolidation way down here, much tighter range. But now you're looking at $5, so you can drop your buy stop from 10 down to 5 and wait for the market to come to you. Again, you're not chasing. And so many people have trouble chasing because they get emotionally invested in wanting to be long a certain stock. Maybe it's because a friend or someone that you look up to has made money with the instrument. Maybe you have strong opinions about the fundamentals. It's all legitimate to me. I'm not putting a stick in anyone's eye, but you can come up with any number of reasons why you're emotionally invested in wanting to buy something or add risk to the portfolio. This example shows you that there's many instances where you could have bought the dip, but it didn't really serve you. You see? Now, without putting any other indicators on here, which are largely useless anyway, you're just waiting for the market to tell you when the selling is over. And then through like December, when it was trading sideways, it gave you a better opportunity. So, maybe now as the thing came down from 40 to 5, my goodness, the thing has gotten crushed by whatever. What is 5 over 40, 1/8? So it's down 87% at that point in 3 months. So imagine all the money that you've saved by not just buying at the market or buying the dip impulsively, right? You act like a pro, you put your orders in, and when the market trades at or through the stop order, it gets activated, becomes a market order, and then you get filled. You see? So that's one way to use a buy stop order, is to enter the market long. The market or the stop order gets entered above the current market price. So if you were looking at how you would write that, you'd say like buy 1,000 shares, Roman numeral M is for 1,000 of XYZ, at $6 on a stop, STP. Now, once that got elected, this part, meaning anytime it traded at or through $6, this then would become a market order and you get filled accordingly. So there's some slippage there. You maybe get filled at $6.01, 602, maybe $5.99, $5.98. But again, when you're trying to make $10, $15 a share, you're not worried about, 2 cents. Now, I know some of you might be trading the electronic pink sheets, whatever those are, penny stocks, that kind of stuff. And so, yes, if you have a 15-cent range that you're trying to buy and there's, anywhere between 1 and 4 cents of skid, that's a different mindset. So I'm not talking about that. I'm talking folks who are thinking much bigger and want to be in the trade for much longer. But that's how you would enter the order to buy. Now, of course, you could put other qualifiers and say it's good till cancel. Sometimes it's good till X. Otherwise, it's considered a day order if you don't indicate it otherwise. And if nothing happens on that particular day and it never trades at or through 6, then nothing's done. The order's canceled. You have to re-enter it in the next day. Now, that might be tedious, but I can promise you the pros are basically managing a book of stop orders, such as this. And so the next day, if it doesn't get filled, guess what they're doing? That's right. They're entering the same damn order and waiting for the market to come to them. I have an example that I might go over because I'm going to do some a segment on this show of best trades and worst trades. And I'll use myself as the guinea pig. And there was a sugar trade in particular where the market was going sideways for like 6 weeks. And every day I just put my order in to buy some, buy some more. And every day the market never got there. So the order was canceled and I had to wait. So that was it. It was just a function of discipline. Now, so this is a good example of how you can avoid a lot of heartache by not letting the market come to you. Now, interestingly enough, say here was your buy stop at 6. Notice that after it broke out, you made some money. Hopefully you didn't take profits too quickly, clicking your heels. Granted, $2 or $3 move on a $6 stock looks like whatever, a third to 50% rate of return. But again, if you look at where the thing could eventually go, you feel like an idiot when you take your profits too quickly. So you notice it starts to range again. Well, guess what? Some of you might want to add to your winners. So what do? You don't go chasing and buy something again when it's in a range. You wait for it to break out above the next level of resistance. So in that case, you can put in another order to buy some more. Let's call that $9. So in that case, you can come back here and say, once you're done on your 6 at your 6 price, you could maybe buy, who knows? You don't have to buy, some people buy the same risk unit, but you could say, I'm going to buy 500 more shares of XYZ at $9. That's a 9 at a stop. This was when that thing gets elected. That's an at sign. And again, it's good for the day. If nothing happens, you don't get filled. But the most important thing is that you don't chase. And so all the time that the market's going sideways here, you're not getting filled, which is fine, right? You don't know where the thing's going to go. The market could reverse and come back here, right? You could also have your protective stop in below the market. We're going to talk about that in a minute. But these are all tactical uses for buy stops. And so it's a very important tactic to use from an emotional and psychological standpoint, that you can put your order in and wait for it, knowing that your futures commission merchant, your introducing broker, or if you're at a full service broker dealer, they're incented to execute your orders. Now, for some of you who might be trading or looking at 20, 30 names at a clip, you can put alerts in, but you could also put in stops. And this helps you babysit the names, because once the thing trades at or through the stop price, you get filled. And then the risk gets added, get the alert. Maybe you get a text message, maybe it sends you an email, maybe it makes a sound on your machine. There's a million ways to get the notices. The point being is that this is a way for you to manage all your orders in a very clever way. It doesn't cost you anything, right? It doesn't cost any money to enter these orders in. They're free. So that's the one tactic that I like about buy stops, is that you don't chase. Because again, what you're trying to do here is counter emotional. When you look at this whole big move, the thing is still in a downtrend. You haven't actually really seen the reversal. So you're kind of getting cute with the market anyway. And if you're going to do that, you might as well use a tactic that can help preserve your capital, or not rush you into a name before it's ready to make the move. Because it was just uncanny that it was once, twice, 3, 4 times it sold off and based. Well, 1, 2, 3 times sold off and based. Then after the 4th time it based, it actually broke through, right? Now, if you're looking, sure, what could happen at 6? Well, it could still go to 0. How much can you lose? 100%. So you're never really free without the risk, but at least you're waiting for the moves to happen, and put buy when there's other buyers buying. In these other instances, up here, and then down here, neither buyer nor seller was in control. And you don't want to get stuck in those range-bound markets because it's dead money, right? So what about this one? Well, you got to exercise a lot of patience, because that's a long time. That's about a month of trading. Now, every day you come in, you're like, man, I want to be in this stock. As soon as you start talking to yourself that way, you realize like the reasons for getting the security in your portfolio may not have anything to do with finance. It may have a lot to do with your emotional constitution and what you feel you're missing out on, and what kind of availability there might be for inventory. But my goodness, with this particular name, there was so much sell-off. You could, the market had to drop in order for the inventory to clear, because there was so much for sale. Right. And so if the sellers are in control of the market, there's no chance or no reason for you to want to be a buyer. Right. So put your stop in. Again, when it trades at or through the stop price, it becomes a market order. There's ways to mitigate the skid by using limits. But again, the more times you have qualifiers, on your orders, the less liquid they are, and you might not get filled on your entire piece. So quick little study there. Now, when you're short, right, you lose money when the market goes up. So again, what do you want to do is you want to cover that short as fast as possible. And the way you can do that, again, is by using a buy stop and putting that above the market. So in this case, if you look at this name, I don't know what this one is. It might be natural gas, April natural gas. You notice that there was a big old range here, choppy market. That's $10,000 range, right? 550 to 450 on 10,000 BTUs. If this natural gas, I'm not making any trade recommendations to be long or short here. I'm just using this as an educational example. But this move, between the two, the support and resistance, that's 10K. And finally, the market breaks through in a violent sell-off. After which point you kind of say to yourself, okay, I'm making money, but now it gets to a point where I have to protect my capital. So I notice that I don't use the whole buy stop loss, sell stop loss, because stops are tactical and they can help you take profits as well as minimize losses. So whenever I hear people just automatically refer to stop losses, I know that they're not thinking clearly, or they fully don't understand the power of the actual order that goes into the marketplace. So all the while, as this market starts to sell off and you're short, you don't want the thing to reverse back in your face. So once you're short and it comes down X amount of space, you could actually put in your buy stop there to get back out at break even. As it sells off even more, you can drop this buy stop to a lower price. So if you're short at 450 here and the thing sells off and rallies back in your face, you can have a buy stop at 4 to cover and to, offset the trade, right? When you're short, you have to buy it in to cover. And in this case, you aren't losing money. You're using it to preserve your profits, your unrealized gains. Lo and behold, though, the market continues to sell off in the direction of the trend, in which case, every time it ratchets down, you can just keep dropping your buy stop order, right? So 2 ways to do this. One is an ATR-based model, because that number is objective. Every time it drops a full ATR, you can drop your buy stop order a full ATR or a half. Doesn't matter to me how you do it, but that's one way to measure it, because it's an objective number that you're not coming up with off the top of your head. Market goes down. So you have a trailing 1 ATR stop, for example. So every time it makes a new low, your buy stop will be 1 ATR, above that lower price. And so you can adjust that all the way down. And this way, stay with the trade for a lot longer, because trends can manifest and move very, very quickly and move for a greater distance and a greater duration than a lot of times people can fathom. Why is that? Well, I hate to say it, folks, but human beings are pretty bad at prediction. They think they have hunches and otherwise, but if you were the person who traded the thing and got out here on this particular big down day, that's great. You probably made 35, 40 cents, which is $3,500 to $4,000. But when you look at the thing having sold off all the way down to 250 from 350, right? That's another 10K per contract. So I don't sit there and start clicking my heels when I realize after the fact that I left a lot of money on the table and all I had to do was sit on my hands because I was already in a winning trade, right? And I have examples of this in my own trading that I'll be showing you over the next couple of weeks and months. So long story short, when you get down to this point after the big sell-off, there is a range aspect of the market. Now, again, sideways range bound markets don't like to trade inside of them. Everyone's got their own style. For me, it's peanuts compared to what, was in the much more pronounced move. But in this case, if you were already short, you had been dropping your buy stop, you can put your buy stop right in here above resistance, so that if the market turns up, you'll get taken out at whatever that might be, 275. It doesn't matter to me, but it's a good way to do it. And if the market breaks down and continues the sell-off, well, that's great. You stayed with the trend. You didn't act out of emotion. You let the market tell you where to get out, and you stayed with the trade for as long as possible. I do admit, though, that it might be harder for newer folks, because once you start making money, it's awfully hard to not want to take that trade and lock it in emotionally. What do I mean by that? Well, say you were trading the Big Daddy natural gas contracts and you were short at 450. When it gets all the way down at 350, this is 10K or 10,000, right? The M is Roman numeral, not K is Greek. So whatever, that's a lot of money. for someone, if they had $100,000 account and they put up the margin, they went short at 450, the thing's down at 350. It's awfully difficult to not want to take that trade off, especially if you're only trading one contract, because there's really only one or two decisions. You leave the risk on or you go completely risk off. There's no middle ground there. It's not like you were trading tens or 20s where you could lift, half of the position or some fraction thereof, protect your profits, but then let the rest of the trade run for posterity's sake in the direction of the trend. So another way to use the buy stop, to summarize here, is when you're short, you can use it. Now, if you're short, you obviously want the market to go down. You can still lose money. We're going to talk about the other aspects here, but in this case, you would sell, whatever, 1NG, I guess it's J23 at 450 on a stop. You get filled, and then you put your protective, buy stop in, maybe risking 50 cents, just so you can put in a protective buy stop to buy one of the same contract at, say, $5 even on a stop. So there's your protective buy stop. Some people would call that your stop loss kind of a deal. I just call it a protective buy stop. Now, as you noticed, the name started to sell off. And so once it went down to, say, $4, then you could change this number to 450. So now you've changed your buy stop to break even. You're in the money by, say, 50 cents or 5K on the trade when the thing's at $4, which is right here, and you've dropped your protective buy stop to 450, and there you have it. Now, as the thing sells off and goes lower and lower and lower, you can eventually trade it, like I said, when it was at this range here, that's about 275. So you could put that in 275 stop. And if the market trades at or through there, and then all of this would be profit, which is represented by the Greek letter pi. So nice trade. Now you let the market do all the work. You stayed out of your own way. You let the market activity unfold. All you were doing was adjusting stop orders, right? Now, at the same time, you could go back over here to this other example, and every day you might be just entering this order. Why? Well, because the market never got to 6 when we were trading through here. Maybe at the same time that you were short the natural gas, you were looking at this name. So every day you're entering the order, to buy 1,000 shares at 6 on a stop. And at the same time, you're adjusting your buy stops on a winning trade lower to take, the profits over the same time. So this way you're not sitting there in front of your screen, trying to scan all these different names, which must be exhausting throughout the entire day. You just have your stops in and you wait for the market to come to you. That's exercising patience, and that's not letting, let me see, what did I do here? Protective stop on a short sale. Okay, so I did this backwards. Protective stop on the short sale would be basically putting your protective stop up here, right? So if you went short at 450, you put in your protective stop above the market, right? That's your protective stop, is to stop you from losing money. So, you could put that in, like I said, 50 cents, anything above the market, whatever you were willing to risk. The key would be to say, like, whatever the difference would be multiplied by 10,000 is what you would risk dollar-wise. And then you'd have to figure out what that is as a percentage of your overall capital. So that would have actually been this order right here, right? When we put that order in, I jumped the gun a little bit here. Sorry about that, folks. So that protective stop would have been this one at, say, $5. That would be what this title is. Protective stop on a short sale would be, I go short at 450, I lose money when it goes higher. So I'm going to put my protective stop somewhere in here, knowing that every penny is $100. I need to know what that is as a percentage of my overall capital. And then this next segment, which I jumped the gun on, protect profits on the short sale, is what I actually described. Tablet. Protecting profits is as you would be dropping your stop orders here. Sorry for that. I misread the damn thing. But the logic still makes a lot of sense, is you have to have protective stops. Now, as we go through, let me see, what was the example that I had here, right? So this is protect profits on a short sale. We could do this again. Market selling off, it kind of consolidates, it sells off a little more. You could say this is consolidation, then it sells off a little more. can adjust your protective buy stops, right? If you went short, say here, your first protective buy stop so that you didn't lose money, right, would be above the market. Then as the market sold off, you could adjust this lower and then adjust it lower and then keep adjusting it lower to the point where you have more consolidation and you could adjust your protective buy stop there. And that would be to protect your profits on the short sale, not unlike what we looked at over here with the natural gas as it sold off. You were dropping your buy stop, right? Now, sometimes that's when the market's going straight down. Sometimes there is structure. So people will say trail structure, right? So if you're short, you can say, okay, I'm going to eventually put my buy stop in above resistance here. As it continues to sell off, well, then you can adjust it and then maybe put it here. So this way you're using the structure of the market, i.e. the chart pattern, other than an ATR-based way of doing it, like over here. Let me clean up some of this stuff. Get kind of crazy with the... See, so here the trend is pretty clear. There's no structure, right? It just goes straight down. It sells off. There's a couple of days in here where there's some, who knows if it's short covering like here or any of these green days, nothing really to write home about or to spook you out of the trade. So there's no real structure there, right? There's a daily chart, right? The only structure comes in down here, basically. Well, sometimes the market does ratchet the way it down like it's doing over here. And there's different stages, right? So there's the initial breakdown at 260 here, right? And then it kind of consolidates once here and then once here, and then a third time down here, in case you can kind of trail the structure and let the market tell you if you wanted to add more to your short here, then you could have added to it here as well, all by putting sell stops in below the market to add to your winning trades. We'll cover that when we go up. So this would be a buy stop order right here to, protect markets so then it doesn't rally in your face and you give back a good chunk of your gains. Interestingly enough, let me cover one thing while I'm here because I see another teaching opportunity. So if you have any questions about this stuff, then either write it in the comments or there's a way that you can contact me through the contact page on the blog, and I'll be happy to answer these things or make it more clear. So you'll notice that there's a damn gap here, right? So what happens with this is that unlike if you had a call option where you could own, a strike price, like say the 140, $45, right? And then this day happens right here where it looks like it opens at 160. This can be a bit of a problem for your stop order. Why? Well, because remember what I said, if I put my buy stop in and I'll write it out, say buy 1,000 shares of RST at say 145 stop. And then I have this gap day and it trades, first trade is through at 160. Well, the stop gets elected when the instrument trades at or through 145. 160 is at or through 145. So then it becomes a market order. Your stop is elected, then this becomes a market order. But guess what? We're no longer at 145. The thing's up 10% from that stop price. So if the market stays, i.e. 159, 160, maybe 159 bid offered 160, I don't know what the spread is. I'm just saying that you're going to get filled on your buy stop in this new neighborhood, right? So that's one of the problems of stops, is that if there's a big gap, you're going to get filled at that new range of where the damn prices are. If you hedged with a call option, like I said, as people can, and say you bought the 140 strike on a weekly option, for example, the gap you're covered, right? Because you own the strike price that Monday or whatever day the thing opens up $15. Whatever you've lost on the short sale because the market's appreciated, you've captured on the strike price. It's another way to hedge. I don't want to kind of confuse the issue by introducing options as hedges just yet, because I want to talk about the tactics. So maybe this is going to happen to you 1 in 1,000 times where you'll have a trade overnight and the market opens up in your face. The truth, though, is that after it consolidated here, it gave you from whatever this is, 125 to 145, it gave you $20 of notice to say you're kind of like on the wrong side of the trade now, right? Despite having a burning desire to stay short, despite having strong fundamental opinions about the particular company, as I like to say, you can't manage risk based on what you think is going to happen next month. You have to manage risk in the now, which is now, 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 and it's ever evolving. So we don't get to pick and choose and say, well, I think next week it's just going to bounce. Doesn't work that way. You can't give yourself permission to take your ear off the tracks. So now we're going to talk about a sell stop order so that we can enter the market short. We might have noticed this particular name. Again, I don't even know what it is. Doesn't matter. I think I deliberately left the tickers off because I didn't want people going to try to emulate trades here. It's not the point of this segment of the show. There'll be other stuff where we might talk about, what's on our watch list, for example, and what we're thinking or what we're looking for the market to do and how we would enter our orders accordingly, letting the markets come to us. Here's what I'm not doing. Don't call me if you're putting 1 minute bars on. It's not what I do. Can't help you. It's too random in the short run. Granted, if you are looking at the dailies and the weeklies and the monthlies, and you notice that at say 345, there's a breakdown, maybe then you could downtime and kind of see, okay, where is the actual or the specific amount of support at that moment of time so that you can kind of better, I don't want to say sniper because I hate that word, as it relates to training anyway. If you got a 50 caliber Barrett, then I'd like it. But nonetheless, if you notice the market topped here at 380 and then it consolidated after a decent run, you notice that the highs were getting lower. Maybe you could perceive weakness and you thought there'd be a wave of, say, profit taking coming. Who knows what your trading style is? It's all legitimate to me. It's all good. So at this point, you notice that there was some support at around, let's call it 345-ish. And you noticed at that point, if it broke through support, it would be off to the races. So in this case, you would actually put in the same type of sell stop that someone would put in if they had bought the market long at 340 and they had watched it rally and they didn't get off out of the trade. They need to put in a protective sell stop. Now, that's the same order for someone who's long at 340 that you're going to use to go short. That's why I don't call it a stop loss, because there's nothing to lose. You're using that stop order to enter the market short. So in this case, we'd say, sell 1,000 ABC is the ticker, at say 340, stop. So that would be, this order here is to enter the market short when it breaks through support. Coincidentally, not to confuse you, for the same person who bought the market at say 340, they would have said, buy, 1,000 shares of ABC at say 340, stop. So this person who got long, say over here on the breakout side, watched the market rally, and to protect his or her or their profits, they put in a protective. It has two roles. For this person, it's a protective sell stop, because now I'm removing the risk. I'll say maybe 345, right? So I'll make some money. But for the person who's not long, say this trade doesn't exist, I'm using the same order. I'm saying sell, right? Because it's sell short. You have to indicate that on the ticket. And I'm selling whatever the amount of risk that I'm willing to take. Sell 1,000 shares, ABC at 345 on a stop, right? To go down. So that's why I don't call this a stop loss, because it's not, there's no such thing here, because I'm flat. I don't have an existing position. So again, this is what I get kind of confused when people write in, they say SL like this. They say, if I put in my SL, so I'm thinking, okay, does that sell limit? Is that stop loss? What does that mean? So I just prefer for anybody who's doing this to be specific and super accurate because language is powerful. And what the language we use with ourselves has a lot of meaning, right? So this is an example of using a sell stop order to enter the market short with no existing position. Notice, like I said, it was the same order for the person who bought long that wanted to use it to protect profits. So the order is the same, but the use is different. Make sense? If it's not, give me a call. Protective stop on a long trade. This is the stop loss that everyone talks about. Again, it's probably the same chart. People watching the thing sell off, it ranges, it sells off, it ranges, sells off, it ranges, and then lo and behold, it breaks out. So now I used my buy stop from the first segment of this little mini lecture here to go long. I call it 125. So I'd say buy, it's hard to write with the stylus, buy 500 shares of MNO at say 125 on a stop. STP, STOP, doesn't matter to me. Your system probably has a drop down menu that looks like market, stop, limit, fill or kill, immediate or cancel. There's probably a whole bunch of qualifiers that they have on your drop down menu. So you would just elect for the stop. Now that order, if the market was trading, say 121, 122, nothing's going to happen until it trades at or through 125. And no, I don't believe in market maker boogeymen that are going to run the stops, because why would they want to buy stock from you, and or sell stock to you and eventually be short if the market was going to rage higher? You know what I'm saying? Like, it doesn't make any sense, because market makers don't predict the future any better than you can, which is probably not good. Now, once I'm long the 500 MNO, I need to protect my capital. And so what I would do is I would enter this here protective stop on the long trade. This is the order that everyone calls your stop loss, right? So now I'm going to sell 500 MNO at say 120. I'm going to risk $5. That's my protective stop. Again, as the market moves higher, I can adjust this and say, okay, now I'm adjusting it to break even. Or I can sell 250 MNO at the market, and I'm going to sell, and I don't have enough space. So now I'm going to change this order and make it 2 orders. I'm going to take partial profits. I'm going to sell 250 at the market and lock in some gains when I'm at whatever 160. But then I'm going to sell the remaining 250, at 160 on a stop. And that's how you take partial profits. Offset some immediately, right? And then leave the rest for posterity, put it in as a stop. Now, all these markets, again, are good for the day, unless you indicate otherwise. Good till cancel is one way to do it. I would not use good till cancel orders. So again, that's the protective sell stop, what most people would call a stop loss. But again, as the market moves up, as it is here, and you move your stop, it's no longer a stop loss. Why? Well, because if your basis is 125 and you sell it at 180, there's not a stop loss. You're using it to protect your unrealized gains if the market does an about face and comes back in on you. Protect profits in a long trade. We just talked about that. Market rallied up here, kind of spiked. This little green thingy was probably above this one at the time. And then, you noticed it sold off. So what you want to do is you're adjusting your protective sell stop as the market goes higher, and probably get out somewhere here. And that, again, if you're long over here and you're selling over here, it's not a stop loss. You're using it to protect your profits, to exit the market long. If you are long, you have to sell it long. And so you get out. So you're flat. You notice after the sell-off, it starts to range again. And you're like, okay, not much of a base, like week or so. So you start to nibble long again at 160. Market soars. And you're like, okay, well, it's super volatile, big $20 days. I'm going to put in my protective stop here. So that would be, again, a sell stop order that you would put in at 210 below the market. So after you were long at, say, 155, you'd have your protective sell stop below the market here. So if the market reversed. Now you say, well, Michael, look at all these big green days. Why wouldn't I just sell into all that strength? Well, you want to buy strength in my opinion, right? You want to buy strength and sell weakness. I know some folks do it differently. That's why it makes this business great, is that you get to express yourself the way you want to. And I'm not here to tell you which way is better, but which way is better for you, you could probably tell by looking at the results that you're getting, right? So go to school on yourself. And if you want some help interpreting the stuff, by all means, reach out. I'll give you some honest and objective feedback. So again, the importance is, let me do the summary. You can do this. I'll do two things. I'll do a little thing on limits, but just so you can remember, say this is the current market value. That's the price of the security. The way you remember where to put the orders are, the buy stops go above the market and the sell stops go below. The sell stops go below, regardless of whether that's your initial protective stop, whether it's when you want to enter the market short, or whether you want to trail with a sell stop to protect your profits in a rising market. Buy stops are the same thing, but you put them above. You put them above resistance if you want to buy that breakout. You could add successive orders above those to get long multiple risk units, right? You could put in a buy stop above the market when you initiate a short sale to knock you out or take you out at a small loss. And after the market sells off extremely in a short, you can put your buy stop in above the market so that if the market does reverse, you get knocked out and you protect your profits. Now, we didn't talk about some of the other orders, but we can go back and do a little bit just to kind of clean this up. The other orders that you could put in above the market are known as sell limits, right? And then buy limits go below the market. And the way that you can remember this whole thing is if you add in a couple of vowels like slobs or bliss, for example, and that will help you with a little tool to know as you're just starting to use these orders tactically, how to remember where they go. So sell limits and buy stops go above the market, buy limits and sell stops go below the market, whatever the prevailing market is at the time. Make sense? So you can cut and paste that. Let's talk about, I don't want to get too crazy with limits, but we can certainly talk about them. Probably the most famous limit order in the history of the markets was actually in the movie Wall Street, after Bud Fox shows up with the cigars and this and that. Don't get me angry, talks about dog with fleas, blah, blah, blah. Next scene, he's back at his office, right? I haven't seen the movie in quite some time, but he's sitting there talking and the guy comes over and says plenty of, cold calling. And then the phone rings and it's Gecko. And he says something like, okay, all right, Bud Fox, I want you to buy 20,000 shares of Blue Star at 15 1/8, 3/8 tops. Don't screw it up, sport. And so what he's actually doing is giving Bud Fox a buy stop limit. He's saying buy 20,000 Blue Star at 15 1/8, 3/8 tops. So this is the stop and this is the limit. Very, very well, obviously popular order because of the movie. Buy 20,000 shares of Blue Star, 15 1/8, 3/8 tops. So what does this mean? So basically when the market, everything, don't forget, there was only 8 ways to split up $1 in those days because decimalization didn't exist when I started. So basically what this does is that, yes, when the market would trade at or through 15 1/8, that elects the order. But instead of, right, because again, this piece doesn't exist. If this piece didn't exist, this stop when it elected would become a market order. You remember that because I just told you. So now the market could go, say the market at the time was 14 7/8 by 15 1/8. So once the market traded at through on the offer, now this became a market order. Who knows where the market could go? Market could go 14 1/2 to 14 5/8, right? He might have bought a bunch of stock at 15 1/8 before it dropped. Now the market's dropped. So when you put in your limit, so I'll write it out full, 3/8. So he's saying buy 20,000 shares at 15 1/8, 3/8 tops. A lot of times if the thing was thinly traded, you might find that there's a big order that could actually push the price higher. So you could bite your nose to spite your own face by buying so much stock, especially with an order like that. If there's 500 to 1,000 share orders going through and they see a big 20,000 share order come through, if they weren't breaking it up, he's basically saying after 3/8, I don't want to buy anymore. So what's better than 3/8? A quarter, 15 and an eighth, 15, right? Now they could break these up and trade into 16ths, but what ends up happening is, say he had this order for, let me clean this up a little bit. Sorry, folks, the stylus is a Bluetooth thingy and it takes a long time to, connect. Okay, so here we are, 15, I'll clean this up, 15 and an eighth, 3/8 tops, meaning that's the most I want to pay. So what ends up happening when you add more of these qualifiers to the order might be less liquid. Why? Well, because between 15 and an eighth, when the thing is elected, and 3/8, which is your limit, right? So again, this is the stop, this is the limit on the stop order, right? If the limit wasn't there, again, it would become a market order and whatever the prevailing market would be. So say the market started to take off because he wasn't the only buyer, Gecko, at the time. So he might have only gotten filled on, say, 15,000 shares. Why? Well, because then the market went 15 3/8 by 3/4. Right? And the 3/8, this is the bid. This is where you sell. You're buying at 3/4. So unless someone's going to be generous and cross the stock for you, which guess what they're not going to do? Cross the stock for you, because that eliminates the spread. So now he didn't get filled on the optimal position. Now he only has 3/4 or 75% of what he wanted to buy. So you got to be careful when you add these limits. If you get too close, the market might run away from you. Now, just while we're here, again, some of you might know this, so I, don't mean to bore you with the details, but I get enough emails from folks that I have a strong sense that that's not the case. So I could also write the same order the same way. By 20,000 blue star at 15 and an eighth stop limit. So now if the market's like 15 by an eighth, right? I better hope that there's 20,000 shares, because now everything has to go through at that same price. The minute it goes 1/4, which is the next eighth up, it could go 15 by a quarter. It could go an eighth by a quarter, right? Again, market's decimalizations, decimalized anymore. But again, you buy at the ask or the offer. So if you entered the order this way at 15 and an eighth stop limit, you're looking at 15 and an eighth, 15 and 1/16 if they would do that for you. So effectively, when you put these qualifiers on, you start making the order potentially less liquid. And so if your goal, you got to remember, if you're running $100 million, you might figure that eventually you want to get to 50,000 share position. So 15,000 is very suboptimal in terms of your risk unit, because even if it went up quite a bit and doubled, what does it actually do to your bottom line? Does that make sense? So you have to figure, most of you probably aren't going to have that issue right now, but you may. Let me show you another example real quick, and then I'm going to shut up because I'm tired of hearing myself talk. Let's go. We're going to buy stop, buy the market long. And let's see. There we go. So I'm here. Good. So this was the first example we used. It's market sold off. You entered the market here. Let's say that you bought the market at 6. So that looked like this: buy 1,000 ABC. I know what this stock chart pattern is. I know what this company is now. Buy 1,000 ABC at 6, stop. Maybe you are really good at anticipating the moves and you have a good feel for, or you know that you got to step away from your screen. And if you'd made a lot of money quickly, you would want to get out. And you noticed after the market broke here, there's a lot of short interest on this stock, quite a bit actually. And you notice that the market started to spike, the shorts would start bleeding out of their eyes and they'd want to cover. So while you have your buy stop here, you might have an order to say sell 1,000 ABC at, again, buy limits go above the market. We could say sell it at 15 limit. So you, again, if nothing's done, it's good for the day. It gets canceled. You'd have to enter the same thing. You could look at this. I hate to say this word, but that could be like a price target. If you bought the breakout at 6 and you said, okay, if it goes to like 12, what's better than 12? Well, 15 is. But it has to go to 15 first, which means the market has to go 15 bid, right? Because this is a sell order. And at that point, this is a suspended order above the market. You have a sell limit above the market at 15. If it trades at or through 15 and you can get liquidated on all 1,000 shares, you might get filled on 700 because the market drops down. So now you still have inventory and you might not want to. At the same time, you can have a sell order to sell 1,000 ABC at 4, stop. Think about that for a minute. Why would you have those two orders in concurrently? And you're not stupid, so you know. One, this is to protect profits if you saw a big spike, and this one is to, minimize your losses. Now, depending on your broker, you could also enter these orders in. I know you used to be able to do it on the floor. Things change very quickly, folks, so don't quote me on this, but you'd have to ask. You could enter this order in, as they say, OCO. One cancels the other. So again, your initial added risk, you bought 1,000 ABC at 6 on a stop, you got filled. Immediately, you would put in your protective sell stop. So, risk $2 a share, risking 2K, whatever that means as a percentage of your overall capital. Sell 1,000 ABC at 4 on a stop, that protects my capital. But at the same time, if the market does rage, I want to take some profits. Now, it might not happen in the same day, but either way, you're removing risk. I'm either going to sell it for a profit or I'm going to sell it for a small loss. And you can have both of these orders in concurrently. Again, OCO, one cancels the other. So if your limit got filled, there's no reason to have a stop in to protect your capital at $4. Why? Because you're not in the stock anymore. You've made your $9, you're gone. So again, I don't want to get into the limits because when the limit is much more stringent than the stop. When the stop gets elected, this becomes a market order. The limit says I need 15 or better. And when you're selling, higher is better. 15, 15.5, $15.10, right, in the world that we live in today. So anyway, this is a little chat that I want to just give you on the orders. I think it'd be very, very helpful to just review it. If any part of it wasn't clear, or I know I was speaking fast, I might have misspoken on a few things, not intentionally, but be sure to reach out, leave a comment in the video. If you want to see more stuff like this, please like and subscribe, because then I can see the data. If you don't like this stuff, why would I continue to do it? I don't want to waste your time. Maybe you want me to talk more about mindset stuff, which is fine with me. But I saw enough of this to know that maybe it was confusing for some folks. So it gave me a moment of pause to say, okay, let me put a few slides together and walk through this and talk about the tactics. Because I think there's enough videos out there to bore you to tears about chart patterns and that kind of crap. But how to trade it is a different ball of wax. That comes down to tactics. That could mean training. It could mean building a system. It could mean sharpening your instincts, using gut feel. It's all very, very legitimate. So anyway, thanks for being here. Make sure you get your copy of the Inner Voice of Trading audiobook, which you can get for free. And again, please like and subscribe. Let me know what you think. If you have any questions, you know where to reach me. Thanks very much for being here, folks. I'll see you tomorrow. Okay, everybody, thanks for being here. Please take a minute, like and subscribe to the show. You could also leave a comment. I don't have all the answers, so it's good to get some feedback. Also, if you would like to support the show, check out the links below. You can get the free audiobook of The Inner Voice of Trading, and also information about the course that I teach with Victor Sperandio. Thanks for being here, folks. I'll see you tomorrow.